Kyle, have we moved? Oh, okay. I can start. Okay, I'm sorry. I thought you were going to introduce me. Well, welcome everybody. I'm Ron Baker, and I'm proud to be here at WorkflowCon 2025. My session is going to be Stop the Leak, plugging revenue gaps in your firm, and I'm really excited about this topic. If you know me, you know I've been on a crusade to change the way the profession prices, to move away from both the billable hour and even tracking time, which are not necessary. And I thought I'd give you some very, very practical strategies to help you stop the leak in your firm in terms of revenue loss. In other words, leaving money on the table. As a pricer, we don't like to see that. So let's start with this. This is a great line by Warren Buffett. Price is what you pay, value is what you get. And that sums it up very nice because remember, in every transaction, there's three components. There's the value of what it is that we buy, there's the price, obviously, that we pay. And then, of course, there's the cost to produce for the seller. But the customer doesn't really care about that. What the customer is comparing is the price to the value that they believe they're going to get. Now, value is an interesting term because it's very contextual and it's very, very subjective. Value in economics is the maximum amount a consumer will pay for an item, but sometimes the consumer is not aware of what they're willing to pay for something until they see it, until they're shown it, maybe use it, maybe drive it, maybe walk around in it if it's a house. Value is very, very contextual, and all value is subjective. And that's another really important point. The other important point about value is when we buy something, we expect to make a profit. We expect to get more value than what we pay. And so not only does the seller hopefully make a profit, not always, of course, but they hope to, but the buyer certainly hopes to. And that's really important because both sides walk away better off from the transaction. That's why both sides say thank you, by the way. It's called the double thank you moment. It's really interesting because that means both sides benefit. Otherwise, one party would say, "You're welcome," but we don't. We get the coffee from the barista, we give our money, and we both say thank you because we're both gaining from the transaction. And that's really important to keep in mind. The other thing is some strategies for stopping leaving money on the table and really upping the way that you price. When I practice, I was the king of telling customers a range of pricing. They would ask me after we had a discussion. We figured out what our game plan was, what we were going to do, and I they would ask me, "Well, Ron, how much is this going to cost?" And I would give them a range. I would say something like, "Well, this will be between 10 and $20,000." Now, I did that because back then I billed by the hour, and since I didn't know exactly how many hours it was gonna take, I didn't feel comfortable giving them an exact number. But here's the thing, if you're smart enough to come up with a range, and you are, because I did it, uh, then it's far more strategic to take that 10,000 and the 20,000 and to offer them 3 choices. So your green card might be the 10,000, you might bump it up to 11,000. Your gold card package might be 17 and your top card might be 20. Um, you're gonna offer 3 different options and let the customer make the decision about price and value. And that's really important because it's really up to them. And as you can imagine, customers like choices. They really do. We like choices as customers. And 3 is the optimal. It's called Goldilocks pricing because most of the time, and it varies, but it's around 60 to 70%, 60 to 75%. Most people will pick the middle option. Now, some people will pick the lowest priced option because they're very price sensitive, or maybe they want to work with you for a while before they purchase other types of offerings from you. And then, of course, some people are going to want the top option. They just want that white glove, pampered first class, seat. They want the presidential suite in the hotel. And the thing is, the way that we're leaking revenue is we're not offering them that. If you don't offer a top option, you'll never sell one. And that's really important. That's why it's so strategic. And this is why most businesses offer pricing choices to their customers. It's small, medium, large, tall, grande, venti. You see it all over the place because there's a lot of psychology behind this, a lot of human behavioral. Uh, the way we make decisions when we're looking at three prices is very different. In fact, folks, I bet where you get your car washed, you see 3 prices, something like this, maybe even more. My car wash has, I think, too many prices, but one of their top tier, of course, is the hand detail. But this lets the customer decide at what value price point they are. Maybe you just want an exterior wash because you drove through a sandstorm, but maybe you want the platinum inside and out wash because you took the family on a long road trip or something like that, and the car's really dirty inside and out. But the point is that you get to decide. So it's really important to offer options. And it would look something like this. And this is just an example, and it's for a firm that does individual tax returns. I just wanted to give you an idea of what it looks like. You can name these things anything that you want. You don't have to use gold, bronze, and silver, and things like that. You can actually ask AI to help you name it. Tell AI a little bit about the customer, what kind of type of business they're in, and maybe you can come up with a nice customized name. There's all sorts of ways to be creative with what you name your options. You don't have to use the standard wording. The other thing that you see here, obviously, is this fits on one page, so it's very easy to read for the customer. And notice that the payment terms are delineated and agreed upon up front. And notice that the cheapest priced option, which is the essential package, by the way, is the price is due up front, 100%. You're prepaid. So your balance sheet is gonna have unearned revenue on it basically until recognize the revenue, but at least you're not gonna have to bill in arrears and chase down payments and have an AR list and billings and collections and all of that hassle. That all goes away because you've agreed on all of this upfront. The middle option here shows 50% now, 50% on completion, but you could change that to anything. The and the top option is the same thing, but you could change the top option to monthly, say, for the year or whatever. But the theory behind this is the lower the price, the faster you need to get paid because that's part of the price value trade-off. Yes, they get a cheaper price in essential, but they have to pay you upfront. Just like when you book a hotel, using their best rate, uh, it's usually 10, 15, 20% lower. But notice that they hit your credit card right then and there, and you can't cancel. Now, if you pick a higher price, they give you a chance to cancel it within 24, 48 hours, usually in hotels. So it's really important to structure payment terms. Payment terms are a big component of price. And if you structure it up front, and agree and the customer agrees what those terms are up front, you should not have to bill. You might have to send reminders that a payment is coming up, but if you put them on an automatic payment, ACH or uh, you know any other type of credit card or whatever, it should just be automatic because you've already agreed on the price, you've agreed on the scope of value of the work that you're going to do, and you've agreed on the payment terms. There's no reason to bill. Billing is just pure bureaucracy. it creates no value. And I think that by itself leaks a lot of revenue, creates a lot of hassle for us. Whereas if you invest the time up front, yes, it takes a little bit longer to create these options up front for each customer, but you're going to save a lot of time in the back end. You're also going to have a better relationship with the customer if you offer them three choices. They'll perceive your firm as higher value. And folks, even if they pick the essential package, the cheapest one, they might look at some of the enhanced services and the ultimate services that they're not getting by picking the lower priced option and say, well, I can't afford the enhanced this year, but maybe they'll trade up next year. It's a way of putting a menu of everything that your firm is capable of doing in front of the customer. And that way they know that, hey, they can help me if I get audited, or they can help me deal with a state tax issue or whatever it might be. And that's really important because so many times, how many times have you looked at a client and maybe asked them about a consulting expense on their income statement? And you say, what's this? And they say, well, we hired so and so to do such and such. And we say, well, we do that. And the customer says, well, I didn't know you did that. And so we lose that revenue. And whose fault is that, that the customer doesn't know all of what we offer? So by putting it in front of them, that is a very strategic and non-braggadocious way to put your entire offerings in front of the customer. And another big source of leakage in your revenue is the hourly rate. So if you look at how hourly rates are theoretically determined, hourly billing is nothing more than cost plus pricing. And cost plus pricing has been around forever. It's easy to understand. It's easy to calculate. We take all of our costs, which in our case would be our salaries, big component of firm costs if you have employees. You take all your overhead. So if you have rent, all your technology that you pay for, your printers, if you have printers, everything goes into overhead, and then you add your desired net income, and that's what DNI stands for here. This is how much you want to earn, desired net income. That's the plus in cost plus pricing. And then you're supposed to divide it by the number of hours that you think you can bill in the course of a year, and that determines our hourly rate. Now, I don't know too many firms that run this calculation to determine their hourly rate. Most hourly rates are usually established by a process known as reverse competition, where you kind of look around at the competition and decide where you want to fit in. Do you want to be on the low side? Do you want to be on the high side? Or do you want to be in the big bell curve middle competing with everybody? I actually rather have you out at one of the extremes. uh, I like you at the high end, but you could be at the low end. That's a very viable business model, by the way, but it takes a lot of work. But either way, I don't want you to be in the big middle competing with everybody, because that's not a good positioning to be in. So the interesting thing about this is when you look at this formula, and it's predominantly how the profession still bills, unfortunately, although more and more this is becoming more and more irrelevant. Somewhere between 30 and 45% of firms are not using the billable hour anymore. But take a look at this formula. There's something glaringly missing, and that is customer value. This is just looking internally at our costs, our profit wishes, and kind of saying to the customer, well, look, this is how much we want to make. So this is what I have to charge you for every hour I work on your account. And that's kind of crazy if you think about it, because again, customers don't care about our costs. They certainly don't care about your profit desires. So even though this can be computed very accurately, we can carry it out to two decimal places. It's precise, but from a pricing and value perspective, it's precisely wrong. And when it comes to pricing and value, I'd rather have you be approximately right rather than precisely wrong. So I want to move you away from hourly billing if you're still doing that. And I'm going to give you a way to do it in an incremental way where you can still feel comfortable, but I'm going to show you a formula, which I'm going to tell you later. Don't use formulas for pricing, but in terms of being able to transition, I think this is really helpful. And then eventually, as you get better at pricing, because pricing is a skill, it's like golf or tennis. The more you do it, the better you get. Now, if you don't like pricing, or if it doesn't interest you, I would strongly suggest you let somebody else price your work, and don't feel bad about that. It it doesn't make you a bad accountant not to be able to price or not to be comfortable with it, because I'll tell you what, all humans are terrible at pricing themselves. We really are. This is why actors and agents have I'm sorry, actors and authors have agents. They have agents that they give 15% of their gross revenue to, because those agents can negotiate a better price. If I'm pricing any of you, and I know some of you out there, um, I think, who are attending this, if I'm pricing one of you, I'm gonna be brave as a lion. I'm not gonna let you give yourself away. I know what you're worth. I know what you're capable of doing, and I'm gonna put a premium price on you. Now, if I'm pricing myself, I'm gonna probably wimp out because I don't wanna ruffle feathers. I don't wanna put the relationship in jeopardy. So it's really important to, if you don't like pricing, you know what? Let your spouse do it. And we're dead serious about this. Your spouse has to live with the consequences of you working real hard, not earning enough money, missing your kids' sporting events, or theater, or whatever they're involved in. Um, y- Somebody else should do the pricing. If you're in a partnership, the partner should not price their own work. The partner should price each other's work. And you'll notice when you do that, that your pricing will be more um, it'll be higher. There's no other way to say it. It's a huge revenue leak when you price yourself. So here's a formula I want to give you. Now, I'm going to show you this formula as a way to compute your 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 bottom option, your green card, if you will, going back to the American Express example. This is your lowest price. This will be your minimum price for this particular customer, and you won't cut this price by a nickel for your own mother. So here's the formula. I want you to estimate, go ahead and estimate the number of hours this job is going to take. I'm assuming that you've already had the value conversation, you've scoped out the work, you have a plan of what needs to be done for this customer, and then maybe you have some things that they might want. So you kind of have an idea of how to build your three options, but now we're focused just on the bottom price, the cheapest offering that you're going to offer them. So go ahead and estimate how many hours that's going to take, and go ahead and multiply it by whatever your hourly rate is if you're billing hourly. So, but notice what I'm having you do. I'm having you do your timesheet in advance. And that's really important, because after the fact, folks, it's too late. Looking at the timesheet after the fact, it's kind of like timing your cookies with your smoke alarm. The data's too old. It doesn't matter at that point that you didn't charge the customer enough, or that you spent more time than you thought you would. Who cares at that point? The price is the price. The customer's only going to pay what they see value in. And so this is why we have to look at timesheets. We have to estimate them in advance, because that's the point that you need to analyze this. And then I'm going to have you add some percentages to that calculation, that hours times rate calculation, for these various, what I'm going to call, price premiums. Now, this is not an exhaustive list. These are just some of the easier, low hanging fruit that you could implement tomorrow with an existing customer, or you could do it with a new customer. But I think because you're offering a fixed price, that commands a price premium, because you're giving certainty to your customer, you're giving them predictability, and that is worth something. Think about a fixed rate mortgage versus a variable rate mortgage. Most of us pick a fixed rate mortgage because we don't want the roller coaster of our monthly mortgage bill changing. So we're willing to pay a higher fixed price for a fixed rate mortgage than we are for a variable. And that says a lot, even when inflation wasn't a factor, and interest rates were really low, and we would have been better off with a variable rate mortgage. 80% of us still picked a fixed rate mortgage. That's because human psychology says people will pay a premium for certainty and predictability. Think about when our phone plans sold us minutes. We always usually picked the option that was too many minutes. We always overestimated because we didn't want to be nickeled and dimed. It's the same with data today. They charge by data now, but you probably have an unlimited data plan because you just don't want the hassle because the demand is unpredictable, but at least the price will be predictable. So you can get a premium for charging a fixed price. I also think you can get a premium for having a change request and a change order policy in your firm. And that basically says to the customer, "Hey, we'll never do any unauthorized work that you weren't involved in, that you didn't have a say in, and that we didn't communicate a price to you up front." Think about your auto mechanic. They wouldn't go in and just fix your brakes. They would call you up and say, "Hey, we noticed when we were doing this service that you need brakes. What do you want to do?" And you say, "How much?" And they tell you the price for the brakes and you make a decision. That's really important. And I know my mechanic is not going to do anything unauthorized for me on my car. I expect the same thing from my accounting professional. If you offer a value guarantee, and this is a big one, you can differentiate yourself from the competition because you're basically telling the customer, "Look, if you didn't get value, only pay what you think it's worth." And you leave it up to them. Now, I know that sounds risky. I'm going to give you some wording on how to do that, but I'm telling you, it can get you an enormous price premium just for a value guarantee. And then, of course, payment terms. You can structure payment terms like I showed you in that example with the three options. And the great thing is, because you know your customer's cash flow, a lot of businesses have a very cyclical cash flow. Think of a Christmas retailer. They're probably going to be flush with cash in October, November, and December and January, but they're probably going to maybe be a lot less flush with cash for the rest of the year. Well, you can structure your payment terms so you're getting most of your price during the periods when they're better off what cash flow wise. And that's really important. That'll help the small business owner, that'll give them predictability. They can budget for it, or you can budget for it a lot easier, and they'll see great value in that. And then you can offer them unlimited access. If they want to meet, if they want to have phone calls anytime, anywhere, any length to discuss anything they want. I don't want you to have a Berlin Wall every time the customer wants to call you. I don't want them to think that a clock is going to go off in the background and they're going to get, a $50 bill for a 20-minute phone call. It's the wrong message to send to our customers. We should build that into the price. Notice it's not free. I'm going to have you put percentages next to every one of these price premiums. And this is what I think they look like. Now I'm going to give you a range because people say, "Well, how'd you come up with these percentages?" Well, I went out to the market and I looked at how much more a fixed price mortgage commands over a variable rate mortgage. And it's somewhere between 10 and 20%. For change orders, I think having that certainty is somewhere between 5 and 10%. For value guarantee, I looked at how much FedEx charges over UPS, and they still command a higher price because FedEx has a world-class guarantee. Absolutely, positively overnight. If they don't deliver, they're you're not gonna pay, period. That's their guarantee, and they stand by that. Now, there are exceptions to that if there's extreme weather and things like that, but the bottom line is the guarantee built FedEx, and they still use it to this day very strategically. Nordstrom, same thing. LL Bean, same thing. We could run down a very long list of service companies that have guarantees. And then payment terms. I think payment terms should at least be your cost of capital. So that's going to be somewhere between 5, 10%, maybe 15. And then for unlimited access, for the feeling that they can call you, meet with you anytime, I would add another 10 or 20%. Now, folks, that's a 45 to 90% premium, depending on where you go. Now, if you think 90% added to your estimated hours times rate is too much, okay, knock it down to 45. Maybe you think 45 is too much. Okay, knock it down to 20. but don't knock it down too low, especially if you're doing the value guarantee, because I promise you, these things are valuable, even though they don't change your costs, even though they don't change your scope of work, right? We're not adding new services here. I mean, I realize the unlimited access might take up some of your time, but that's okay. You we got to stop looking at the math of the moment and think about the relationship. Customers really value having access to you. And I'm not talking about on Saturday night at 2 a.m. in the morning. You know, I, I, I know Dawn talks about setting boundaries, and she's absolutely right about all that. But the fact of the matter is, if your clients call you at 2 a.m. on Saturday, you probably want to talk to them. Something's gone, something's happened, and you want to be involved. That's why they're calling you, because you're their trusted advisor. So we shouldn't have Berlin walls or clocks that stop them, prevent them from calling us. And so go ahead and add, 30% to your estimated hours times rate. Now that's going to be your bottom offering. And so we did something very interesting when we did. And by the way, here's the value guarantee verbiage that you can use. And you can see our work is guaranteed to the complete delight, not satisfaction, delight of the customer. And you can put the customer's name in there, obviously. If you are not completely delighted with the performance of the firm's name, obviously, we will, at the option of the customer, either refund the price or accept a portion of the price that reflects the customer's level of value received. Now, this goes right into your engagement agreement, your fixed price agreement. It's a value guarantee. It shows the customer that you're aware of the value that you deliver and you stand by it. You're willing to bet on yourself. Because if you're not willing to bet on yourself, why should a customer bet on you? If a new car company, say, came out and only gave you a 1 year, 10,000 mile warranty, what would you think? What kind of message does that send? They know they're building crap, so they're not going to guarantee it very long. It doesn't send a good message. This sends a very, very strong message. Hey, we're good. We're not the cheapest accounting firm in town, but we're worth it. And by the way, if you're not satisfied, if you're not delighted with working with us, you only pay for the value that you think you received. And I think this puts a burden on us to step up our game. We're putting our money where our mouth is. But I'm telling you, a 20 to 30% premium across all your customers is worth taking the risk, because hundreds, probably thousands of firms have worked with this guarantee. My veterinarian used to have a guarantee, and it wasn't that he was going to keep my dog alive, or we're not going to go out there and guarantee that we're going to win every battle with the IRS or whatever. That's not what you're guaranteeing. You're guaranteeing that they're going to be happy with their customer experience of working with your firm. And it forces us to up our game. And I think that alone makes it a worthwhile strategy to deploy. So let's go back to this cost plus method. The other thing I need to say about cost plus, have you ever noticed in the accounting profession and other professions, by the way, that bill by the hour? We're not the only one. Lawyers, advertising agencies, consultants, IT consultants, actuaries, some of them still are billing by the hour. Have you ever noticed that the realization rate is always less than 100%? Very few times do you go over 100%. Now, that's because this formula automatically caps how much we can earn. We're starting off with a business model that limits our income. That's kind of insane by itself. And so, what I've done now is I've given you a formula. If you follow that formula, you estimate hours times rate, and then you add, say, I think we said 30%. Um, but I think it could be 40 to 90, by the way. I really do. Um, and you could test that. You could test it on a customer, a new customer, put in 90%, see what they say. You'll learn something, trust me. And if you do that, now your bottom price is a cost plus that 30%. And of course, obviously the DNI's in there. And so what have we done with the ceiling? We've moved it to a floor. The ceiling is now a floor. And now you have two other options that are going to be higher than what we just calculated for the bottom option, for the lowest priced option. And you're gonna be able to break above that ceiling, that artificial ceiling, by the way. It's completely artificial. We put it there. I don't care what your hourly rate is. This is why you're seeing crazy hourly rates. We just saw a law firm in Australia go to $3,000 an hour. I don't know about you, but no customer's gonna accept that. Very few are going to, wanna even call the lawyer because, geez, if they spend 2 minutes talking about the kids, it's gonna cost, a night on the town. I mean, it's crazy because it has nothing to do with the value that we create for our customers. So, if you can offer options and you can make that bottom price that in this case, I'm showing you a Canadian bookkeeper. Um, I really like how she lays this out. I like that it fits with her logo and her colors and all of that. Notice that you always lead with your most expensive option, but her bronze package here, the 2200, would be from my calculation that I just showed you. The estimated hours times your rate. You could even up your rate by 10 or 20% if you wanted. Then you add that 30% for all those price premiums. And now you have two other packages. The reason I even have a copy of this is because this was the first gold package she sold at $4,000 per month. Notice she's got a service guarantee. Notice she's got payment terms computed. Notice that she put a deadline on this. No price should last forever, you know? So this is this quote, if it's a proposal that you're giving, put a date on when it expires. The last thing I want to happen is you give a proposal and then somebody comes back a year later and says, "Oh, okay, I'm ready to go now." Things might have changed in your firm. You know, capacity might be an issue now. The price shouldn't last forever. Airlines change their prices something like 14 million times a day. Uh, no price should last forever. We find about 3 weeks. Make the proposal, make the proposed price expire in 3 weeks. That seems to be just the right amount of time. 2 weeks seems to be not enough time sometimes. A month seems to be too long. We found 3 weeks work, but you can test that as well, see what's right for your firm. Um, and this makes it very easy for the customer to look at what they're getting, how much they're doing, how much you're doing, and it makes the whole I think it strengthens the relationship. So offering options is a really, really smart thing to do. And then the other thing is another big source of leakage, and there's actually two. One we talk about all the time. We get wrapped around the axle about scope creep, and I'm sure you're aware of scope creep. Everybody talks about it. Everybody gets all, you know, discombobulated when the scope changes. And now the policy for this is the change request change order process. And it should be a policy in your firm because policies are really difficult for customers to argue with. If something's a policy, it's a policy. It's not a preference. It's a policy. It's how we work around here. Just like contractors, just like auto mechanics. Every time the mechanic finds something else wrong with your car, they're triggering a change request. Uh, just like if you worked in a company and you want a new laptop, you probably have to fill out a purchase request, and then somebody has to authorize it. Until then, it's just a request. But once it's authorized, if your boss or whoever has the authority authorizes it, then the purchase request becomes a purchase order. It's the same thing here. A change request is drafted once you see once you spot scope creep. And scope creep can be spotted by us, and it frequently, most of the time, is spotted by us, but it can also be spotted by the customer. Sometimes the customer drives a scope creep decision. And then I want you to ask a strategic question. When you're confronted with a change request, the question I want you to ask the customer is, what is the business purpose of this change? Why are you requesting this change? And there should be a business purpose for it. And then another fantastic question, and folks, this is a very well empirically tested question, is what is my budget, or you could say our budget, for this? Because we started by asking the customers, what is your budget for this scope creep request, this change order? And they would say, well, I don't have a budget for this. So we started asking them, what's my budget for this? And boy, they would usually throw out a number that was very, very reasonable. In fact, it was higher than the number I was thinking. And we just say, okay, we can work with that. And then there's no hassle. It's really easy, and you can see this boat. This is I thought this was Photoshop. This is an actual contractor's boat, and of course the name of the boat is Change Order. And I don't know if you can see it, but the little dinghy is called the original contract. I mean, it's a funny way of portraying that change orders is where contractors make the bulk of their profits, right? If any of you work with contractors, you know how important change orders. In fact, I think it was contractors who invented the change order. And the change order is really an incredible tool because it does something very important. It gives it keeps the customer in the driver's seat with respect to the decision of whether or not to go forward with the change. Just like when the mechanic calls you and says you need brakes and you say how much and he says $500, and you're sitting there realizing, oh, he's got my car ripped up, ripped apart on the rack. Yeah, go ahead and fix it. Most of the time, as long as you think the price is reasonable, you'll authorize the change order. So you stay in the driver's seat as the customer, but the shop has the leverage. And this is a really important point, and more leakage happens because of this. A service that is needed is worth more than a service that has been delivered. A service that is needed is worth more than a service that's been delivered. And this is why it's important to price upfront everything. Very little exception to that, because you don't want to deliver a service and then try and collect on it 3 months down the road. It's crazy because the time pressure, the desire has all been lost at that point. It's no longer the same service after it's been delivered. So the willingness to pay is at its highest before the service has been delivered. So it's really important to have a change request and a change order policy in your firm when you encounter scope creep. Now, I want to tell you something about this because I don't like scope. I'm trying to move the profession away from even thinking about scope. I rather see you price based upon the nature of the work that you're doing for your customer, your role, in other words, rather than the scope of work, because I don't think the value is in our services. I think it's in our advisory, our guidance with the customer, moving them from where they are to some desired future state. So I'd rather have you think about the nature of the work. So I'll give you a very, very practical, tangible example. What if your three options were, we can be your accountant or bookkeeper, whatever the case is in your firm, we can be your accountant, and that's one package at one price, or we could be your controller, and that's another package and another price, or we could be your CFO, part-time, obviously, fractional, whatever. Now, obviously, those are three different roles. Just like if you were to hire a bookkeeper, a controller, or a CFO, you would expect to pay them much different prices, right? Wages, because they're different roles. They're capable of doing a certain thing and staying in their lane. And what I like about that is if they pick you for an accountant, you're not going to do things that would be expected from a controller. Maybe you're not going to do cash flow projections or budgeting. Maybe you don't offer in the accountant package um, you're certainly not going to be at the board and, in the C-suite in board meetings. Uh, Basically, the role of the accountant is hindsight, right? You're going to deliver historically accurate financial statements and make sure the books are orderly and balance out and all of that. So, but if you're a controller, you probably will do cash flow and budgeting. You might even get into procurement and saving money or collections, to collect the receivables faster. There's certain things that controllers do that accountants don't. And then, of course, if you're a CFO, well, now you're going to be more strategic. You are going to be in the C-suite. You are going to probably have a seat at the table when it comes to strategy, pricing, KPIs, other types of things. So think of it this way: the accountant offers hindsight, the controller offers insight. In other words, real time information to help the business make quicker and better decisions, like moving them from desktop to cloud. At one point, that was a big change, and that gave us real time insight. But the CFO is also, they're still doing the hindsight and the insight, but the CFO is also offering foresight. They're helping us plan the future, not just report on history, but make it. And I think by charging, just change that one term, not scope of work, nature of work. You'll blow up scope. You'll never have to do another change order again. And that way, if you're, say you're in the control, the customer picks the controller, and then they want you to do something that's in the CFO package that you have. Maybe they want you to do some modeling or some FP&A type work, financial planning and analytics. They have to upgrade into your CFO package. Now, you've got to make it easy for them to slide back to the controller if that is their desire. But once they see what you're capable of in the CFO package, they probably won't want you to move. So that is just another way of blowing up scope, because I really don't like scope. I don't like all the time, and the friction it creates. You know, just because the customer adds 10 employees or gets another bank account or credit card, we go, "Oh, the scope's changed, the scope's cha," and then we have to go to the Department of Paperwork and do a change request and then a change order. It's friction. It's not simple, it's inconvenient. It creates another pricing hurdle for the customer. You have to put another price in front of them. It's much easier just to say, "Here's the nature of the work, and anything that an accountant can do, that you do, you're covered. If you need it, you're covered." Now, look, if you don't offer that service, don't try and do it unless you want to. But I think this is what it really forces us to stay in our lane, because I believe firms are defined by the services they don't offer. It's really important to stay in your lane. You know what? My insight on this is the medical profession. I've always hated scope creep. I've always hated change orders, even though I was one of the first people to write about them in the professions and introduce the concept. But what dawned on me is doctors don't have scope creep. Why not? Why don't doctors have change orders? Or, but more importantly, why don't they have scope creep? Because doctors stay in their lane. If you have a general physician, you know he's not gonna replace your knee or your hip or give you cardiac surgery or give you cancer treatment. He's gonna quarterback you to a specialist. Now, he may be involved in the meetings with that specialist and make sure your medical history is understood and all of that, and still kinda quarterback the relationship, but he's not gonna be doing that work. I think too many times, just because the customer asks you to do something doesn't mean you have to do it. In fact, you have a professional responsibility perhaps not to do it, because there's a professional code that says we have to do things with due care, meaning only things that we've done before and that we're good at. And if we haven't done it before, we're supposed to act like an apprentice, and we're supposed to have a journeyman over us, just like they do in the trades. And I think we've lost sight of that. But when you read the canon of the what it means to be an accountant, due care is way up there. It's one of the 6 guiding principles of the profession. And therefore, I think it's really important to list what exactly it is that you're going to cover. Don't try and list all the things you're not going to do, because if you leave something off, then it's going to be assumed by a court, say, that, well, then it's obviously included if you didn't list it as an exclusion. So only list the things that you're going to do. And then that way, if the client makes a request or something comes up that you've never done before, it's your discretion whether or not you want to do that or whether or not you want to bring them to another specialist. The other thing that happens, it besides scope creep, by the way, is scope seep. And that is when we add more value that the customer didn't request and didn't even know about. We do something, we do a special project, maybe the data they gave us was corrupted, we fixed it, whatever. The scope seep, I think, happens a ton. And it's just because we have wimpy pricing that we're not capturing that. So it's not just scope creep that's a problem, it's also scope seep. Um, the other thing is customer segmentation. It's really important to go after the right customer. There's no way to value price the wrong customer. And essentially, in this framework I want to show you, there's four types of customers. So on one side of the graph, we have the value of your brand to the customer, the value of your firm from low to high. We have the pain of price. Again, this is from the customer's perspective, from low to high. And then here are the four types of customers. You have convenience buyers. Now, these people don't put much value on your brand. They might put more value on your location. But you know what? These are interesting customers because their pain of price is low. In other words, they're willing to pay a very high price for convenience. And think about 7-Eleven. 7-Eleven is built, their entire business model revolves around convenience buyers. It's the customer that knows, yes, I'm going to pay an extra buck a gallon for the milk or whatever, but I don't have to drive, another 5 miles to the grocery store. It's right by the house, it's convenient, I'm willing to pay the premium. That's not a bad customer because those customers can usually be moved. Now, the worst type of customer is the price buyer. They have a high pain of price and they don't value any loyalty to you whatsoever. If somebody discounts the price by $100, they're gone, right? These are the people that constantly churn through their mobile phone or their cable company, um, or switch hotels. They don't care which hotel, as opposed to a customer who may be loyal to a particular airline or hotel. You don't want price buyers, folks. Identify them early and don't let them pollute your river. Send them on to your competitor and let them ruin their business. And then you've got value buyers. These people do value your firm, your firm's brand, your reputation. They value loyalty, but the pain of the price is still high. In other words, they're going to constantly keep their eye open for other alternatives. It's not that they can't be loyal, they can be. It usually when you look at, loyalty programs, these value buyers, they're in the 1st or 2nd tier. They're rarely in the top tier. The top tier are your relationship buyers. These are the people that love you, are loyal to you, probably refer others to you, and they have a low pain of price. Why? Because they know what you're capable of. They've seen you create tremendous value. The profit they get from the relationship with you is very high. Remember, customers have to earn a profit too, not just us. In fact, price is how we divide up value. That's all it is, really. Value is just price is just how we divide up that value that we're creating. And so these four types of buyers, they're kind of interesting, but stay away from the price buyers. That would be that would be my biggest takeaway from that. And then the other thing to help you stop the revenue leak, I wanted to show you the margin tables because I find that this stiffens the spine of a lot of accountants. What this table shows you, and the numbers across the top are your firm's gross profit. So if you were just to take your revenue and subtract your cost of labor, that could be outsourced labor, could be employees, independent contractors, whatever. No other overhead, no rent, no technology, just direct. This is our idea of a gross margin, right? Let's say your gross margin is, I don't know, I'm making that up. Let's say it's 25%. If you were to increase your prices across the board, across your entire firm by 10%, what this table shows you is that you would have to lose 29% of your revenue in order to break even on profit. In other words, you could lose almost 30% of your revenue and still break even on profit. Now, if you increase your prices by 10%, are you going to lose 30% of your revenue? My guess is not. No, you're not. And so we always like to tell people, what if you increased your price by 30% and you were in a 25% gross profit situation? You could lose 55% of your revenue and you would still break even on a profit level. So you'd have fewer customers and you'd make the same amount. Now, even if you were to double your prices, you're not going to lose 50% of your revenue. It's not going to happen. So we find that this really stiffens the spine of accountants. And if we flip it to the other side, what if you offer a 10% discount to your customer across the board? All your customers get a 10% discount. You're at 25% gross margin. Do you realize you have to add 67% to your top line in order to break even on profit? This is why these margin tables are the profit break even. And there's a whole bunch of math that goes behind these tables. I can give you that if you want. You can email me. I'm happy to send you the margin tables in a PDF. But it's really important. And we've got some additional resources where the margin tables are included. So I know those are part of this session today. So, but I just wanted to show you that because I think they're great tools. So let's recap. A good price is it prices the right customer. Don't bring on the price buyers. It comprehends the value drivers. What is the customer trying to achieve? What is their desired future state? A good price knows the scope before doing the work, and more importantly, knows the nature of the work. Are you an accountant? Are you a controller? Or are you a CFO? It recognizes the sooner you price, the lower it will be. Never quote a price before you're ready. I don't care how many times the customer asks. Because the sooner you price, the lower it will be because you just don't know enough about the customer. Do a thorough diagnostic, poke around in their books, have conversations with them, ask them what it is that they're trying to achieve. And that's a way not only to manage their expectations, but to see if they're a good fit. And know if that you use a formula, your price will be lower. Even the formula I showed you, because after you do this a while, I promise you, you'll throw that formula away and your prices will start to creep up commensurate with your value. And know and recognize that a good price isn't the only negotiable item. If somebody asks for a discount, send them down to the bottom level. That's why you're giving them three options. It's not a negotiation. And if you want to negotiate on something, tweak the payment terms. Don't change the prices on your options. Price is a terrorist, and what I mean by that is it brings up more fear in our mind than the customers. You're gonna fret over your first three options, but then when you slide it across to the customer, they're gonna look at it and go, okay, let's go for the top one. And you're going to think, oh, gee, I sweated for 2 weeks and then he made a decision or she made a decision in, less than a minute. That's a good sign. You should fret over your pricing more than your customers do. Don't let your price be set by your stupidest competitor. I don't want that to happen. Your competitor doesn't care about you or your firm or your customers. Certainly don't let them set your pricing. Your firm's different. You're unique. What are your uniqueness and your value proposition, and your price should reflect that. A good price prices the customers, not the services. It doesn't price the scope of work. It prices the holistic customer, where they are in life, where they want to go, what the value is to them. Each customer is different. It's like eyeglasses. Nobody's got the exact same prescription, and a good price benefits all stakeholders. Um, so, folks, I wanted to give you a couple more resources. These are also in the notes, I think, as part of this session. I wrote an article for the Journal of Accountancy, Pricing on Purpose. It's got 15 or so, or 11 or something like that, exhibits attached to it, sample forms, questions, help you develop your three options. You can find that at Journal of Accountancy by putting in my name and this title. And you don't have to, it's not behind a paywall, it's available to anybody. And then my colleague Ed Kless wrote Project Management for Accountants, which is really important. And so take a look at that. You can get that for free as well. This is how you can learn more about me at thresholdnow.com/revelation. This is kind of our revelation for the transformation economy. So it's what we're most excited about and what we see coming down the road for the professions. And if you want to kind of peer into the future, take a look at this document. And of course, this is how you can contact me. I'm on Twitter, I'm on LinkedIn. You can email me. Happy to chat with any of you. You're all colleagues. And so I'll stop sharing and I'll bring it back to KO. I know I'm a little bit over, but I want to thank you for attending my session and hopefully we can continue the conversation. The best way to be transformational. Shannon, yeah, guide their transformations. Um, uh, I'm not sure if we're still on the air, but how do you address out of scope requests without leaving the clients with a feeling of nickel and diming? Marina, this is why I don't like scope. Charge based on the nature of your work. Are you an accountant? Are you a controller? Are you a CFO? You don't have to use those titles, but do it based on the nature of your role, not the scope of the work. If it fits within the nature of that role, it's included. If it doesn't, they have to move up to the next level. Do you suggest tiered proposal service? Yes, I do, Kaylee. Do you cut the customer loose if they call in the value guarantee? Lee, that's a great question. It's up to you. It's up to you. If you don't think it was justified, a lot of times when they call the value guarantee, it is justified. We screwed up. Um, but if it's unjustified, I think the customer did you a great service. They identified themselves as a pain in the butt, and yes, cut them loose. Absolutely. How do you control the nature, scope of work to be sure what you think you are doing and a client thinks your role is? If you don't define the activities or deliverables, you need to manage that risk. Yes, you do, Rick. Of course, you need to define the offerings that you're going to give within each role, but, if it's in there, it's covered whether or not they need it. So, that's how you handle that. I know we're over on time. I'll take one more question here. I'd love to answer all of these folks. How do you factor in complexity and or sheer transaction volume? I understand the value added of addition reports and analysis, but I see my firm owners say it shouldn't matter what the transaction volume is when doing value-based pricing. Megan, it shouldn't. I mean, transaction volume, look, AI is going to take care of this. Let's not kid ourselves. AI can do something in a half a minute that took us hours. The value is not in the transaction level or how many employees or what their revenue is. It's in the guiding of the transformations. It's in your guidance. It's in your wisdom. It's in your trusted advisor status. By the way, that's a term you should never use. That can only be used by your customers. um, don't worry about it. Now, sure, I want you to think about the risk of the customer, but risk profile is not the same thing as complexity or size of transactions. Um, this is also much easier if you're focused or niched because you kind of know what the rails are for your sweet spot for your firm. I don't want you to have, $10,000 customers, but also have a couple $100,000 customers. To me, that's not th- that doesn't work. I mean, that to me, that's two different businesses, and it's not good to have um, that type of disparity in your firm. Um, what is D&I on the hourly rate slides? Desired net income, Lee. And then how do you help firm owners get past the emotions of doing all this hourly billing tracking? Sometimes just the effort to collect the data seem like, oh, carry it, Carl, it's unbelievable. It's really hard to get them over hours, timesheets, time tracking. It's a nightmare, but it can be done. And thousands of firms have done it. Even some I know are on this call. So, Kyle, I know I got to go. Folks, thank you so much. If you want to continue this conversation, email me. My information's on the slide deck. I am happy to chat with any of you. Hop on a Zoom call. You're all colleagues. I want to see you succeed. Thank you so much. Thank you so much to the Financial Sense team. This has been wonderful, and I look forward to seeing you guys down the road.